Looking at the month-on-month number, the rise was 1.2% from 0.7% in February. March, though, is a high survey month. We also had a few increases pushed through in the budget, such as sin taxes on cigarettes and alcohol. So are you concerned with today's reading?
I don't think it's particularly a cause for concern. As you say, it was expected. We are now in an upward phase of the inflation rate cycle. And as the Reserve Bank has pointed out repeatedly, it's more from the production side, supply side of the economy, that the pressures are now being felt. Culprits, as we all know, basically from the international side of things, including food prices, which have been escalated in excess of 30% over the past couple of months, international food commodity prices, that is, as well as the oil price, which is now 122. So we will have the base effects of oil for probably a couple of months still hanging in there. And hopefully oil will be relenting soon, but there's no guarantees in that regard. And those are the factors that are driving inflation. And inflation, unfortunately, is probably going to get higher from these levels, although not, I think, completely out of line with expectations.
How would you see it accelerating going forward? Where do you see it at the end of the year? Because the Reserve Bank is still confident that it will remain within targets until the end of 2012.
Well, we have a forecast pitch at roughly around 5.5%, between 5.5% and 6% for the end of this year. On average, we're working on just under 5% for this year, 4.9%. But of course, the joker in the pack, once again, the oil price. And of course, the provision is that the rand should hold. If the rand does depreciate rapidly, then of course the whole picture will change. But we're not working on that. In fact, I think more rand strength can be expected against the dollar, not so much against the euro, but more against the dollar. So it will be a sort of evening out as far as the effective exchange rate is concerned.
When do you start to factor in the second round effects from that high oil price and those rising food prices, and even the third round effects? When did they start to filter into the basket?
That will be starting already. I mentioned that we have a forecast of 4.9% for inflation, although we worked on an oil price of about $105 per barrel. If that should be $10 higher than that, we can see inflation going up by 0.3 of a percentage point. And that's just the first round effects, and double that if one to take all of the effects into account, so the second and third round effects. So inflation could be higher by between 0.5 and 0.6% if the dollar oil price is higher by $10.
If you're expecting inflation to average just below 5% for the entire year, what's your thinking on interest rates? Are you in the camp that thinks we'll only have an interest rate hike next year?
I think the chances are that we can see already something by the end of this year, but definitely I think in the early part of next year, if it's not the end of this year. So yes, I think coming this time next year, we will already have seen an interest rate hike.
Well, we had that IMF report out at the beginning of last week talking about South Africa's growth. It expects 3.5% growth this year, and it doesn't expect interest rate increases because it doesn't see the economy strong enough or warranted to have an interest rate hike. Do you think the IMF's being a little bit pessimistic on its growth expectations?
3.5%, it's not too much out of line with our own thinking. We're expecting 3.7%. And in a global context, especially if you look at the developed world, of course it's a lot better. But comparing ourselves with emerging markets, it is on the low side. But of course there are macroeconomic obstacles in our road to recovery, which have not necessarily been the case in other countries. So I think it's more or less aligned with the general view.
So with growth perhaps a little bit sluggish and with the labour market still starting to recover, do you think it would be a risk to raise interest rates sooner rather than later?
Yes, it's not a clear-cut case, as was probably the case when the previous rate hiking phase set in. Consumer demand is really not picked up to the same extent. Indebtedness haven't started to increase despite the lower cost of credit. Credit demand itself is very much still in the doldrums. So, and if you look at the property market, that's very flat, and in fact it's actually deteriorating. So all of those, makes a very difficult decision probably this time around. But once again, the Reserve Bank will keep their eye mostly on the target, and they would not like the target to be exceeded. And I think that's the main reason for a moderate increase in interest rates, not a massively aggressive one.
Well, staying with consumer demand, we're getting retail sales out shortly. That's for February. January's reading 6.4%, and that came down from about 8% in December. What do you expect for February? Are we going to see that consumer demand starting to come through in the retail sector there?
I haven't really looked at the trends on a month-on-month basis, but presumably, the positive factors are still there. We are seeing significant increases in labour remuneration, as you've mentioned, especially on the public sector side. Interest rates haven't budged. So I think the table is still laid for significant increases in retail sales, at least, given that the demand for housing is very much on the decline.